Welcome back to a brand new episode in the Stocks and Shares series, the series where we deep dive into all things investing in stocks and shares. A series that was born out of an idea by me and my friends who are always talking about investing on group chats in person, something that's encouraged massively in the modern day. So I thought, why not bring this series to YouTube? And to everybody supporting it so far, thank you very much. Now, I should say, as always, I'm not a financial advisor. But deep diving into it straight away, what an absolutely mega few weeks it has been. Up, down, sideways, left, right, tariffs, this, that. The market's taken quite a reaction to some recent discoveries when it comes to AI as well. And we've seen, obviously, Adobe's a massive stock that gets hit by any AI news or any generation news for content. We've seen the likes of Nike have a small rebound, Coinbase go down a lot but then come back up, and there's a lot to dive into. But first things first, let's just take a look at the overall portfolio health. So again, at the moment, we're sitting on this fake money account at a overall positive sum, but recently negative. Currently, my scenario over the last week, if we take a look at this, or even last month, is down £500. And the reason why that is down £500 is largely due to the fact of Adobe not quite doing that well for me. I think straight away, when building a position, dollar cost averaging is something that is quite a good thing to do, historically speaking, according to textbooks, where rather than put all your money in at once, slowly over time, you put a small amount in so that then you can average out your average price, which is down here, just in case things go pear-shaped. And that's what's happened here. Adobe's down 20%. I think some people are saying it's undervalued. Some people are saying that ultimately Adobe's got no future because AI is going to create all the content. And I don't disagree with the fact that AI will create a lot of content. But the reason why initially I thought, personally, not financial advice, but Adobe was a decent investment, is because of the nature of how it works, in the sense of it's got such a rich bank of history of content. It's got such a great fundamental base to build their own models, for example, to generate content, that if you've got a dedicated place where you can get the finest AI generated content, the most customizable, then I think that Adobe would have that initial backbone to do it. Hence why I just bought another 10 shares. I like to see this. My average now down below $300. So I'm 13% down. £900 is a lot of money. 13% isn't the worst as such. And the average price there, $297. I think it is tempting to buy a bit more given how it looks on this graph, but I think that's a solid place to be at. If things do pick up, if the narrative changes around SaaS products and companies, maybe that will have a strong rebound. Like I said before, I'm looking for a long-term picture with Adobe to be a winner in the AI race. But let's talk about Amazon before we dive into any new positions. Amazon has absolutely crushed it up until now. So over the last year or 2 years, it's gone up quite a lot. And I should say, everybody who's tuned in recently, you gave me some stuff to look at in terms of stocks to take a look at. Fertilizer stocks, a few other ones. We're going to deep dive into those. But just running through the portfolio on Amazon. Last 3 years has crushed it. Recent drop-off. Why is the drop-off? They've announced a large amount of CapEx spending. And so with that CapEx spending, that basically means that the balance sheet or the earnings doesn't always look as healthy. Anthropic has come along and delivered some key products, but I believe, double-check this, that Amazon owns part of Anthropic. And I think it's quite a high conviction play for me in terms of Amazon personally. And a lot of other people believe this is probably one of the most bought retail stocks. While retail investors are buying, everybody else, and hedge funds and institutional investors, I should say, have been selling, which is always worrying. But, just that's why, I don't want to deploy all of the firepower I have in this account at the moment, because you hear the stats are saying that institutions are selling apparently while retailers buying. And that's normally not the most productive sign. If I take a look at my average price here on Amazon, it's pretty high, not ideal. But that is now sitting at 8% loss, but at $228 average price. And I've got a sizable chunk there. I think I'm happy to hold this and ride it and see what happens. What is happening with Nike? Nike has been up and down over the last 3 months. My position is basically net neutral, £12 up. The Vanguard is quite a safe place to be right now. There's been no major ups or downs, and I've just got a bit of money in there ticking over. Oracle, the same thing. Copper, not quite done what I wanted it to, but same thing. Coinbase, yeah, 5% up. That's pretty solid. £21 is borderline worth taking, and then Rio's up as well. Should have put a bit more capital into that, but I just get a bit scared when I see the graph flying. Satl announced a few good deals recently, spiked up to $4 and then fell back down. in the last week, I believe it was. Yeah, just there. My average, I'm a 16% down. I haven't got a massive position on this. There's a good chance to get back in and bring my average price down. New broker target, $7. What do broker targets mean? Sometimes they're right, sometimes they're wrong. Often, I've been in scenarios where they haven't actually done what they said on the tin. I think this is a reasonable good price with my practice money and not financial advice to go and buy a decent amount of shares. Why? Because I think this market is going to hot up. They're a vertically integrated company, so they get the parts, they build the satellites, and they ultimately deliver the product to the end user. And they're trying to build some pretty cool stuff with live monitoring. And they've got some good quality high-res satellites that I think is 50 centimeters of accuracy as opposed to smaller 30 ones. We'll double check that later on, but I believe from my research earlier on today that they're quite a strong position. This could also be an interesting one to trade because it is very volatile, but with volatility comes risk. Oracle, copper, cool. So what do I want to have a look at? But first, I would love to add this to my watch list. Somebody recommended it to me in the last episode of the Stocks and Shares series. They said, add to your watch list EEE, Empire Metals. So that's what I'm going to add to my core metals list. Against the trend over the last month where core metals typically have been rising, but what I can see, it's a penny stock. And with penny stocks, having not done that much research, always extremely volatile until they find some good sort of resource. Or if they don't find resources, the biggest question is how much money do they have to try and find resources without going into too much debt and financing that resource allocation discovery without accumulating too much interest. It's pretty complicated. Penny stock is something I've been in for a long time, hence why the negative P ratio. Very small market cap, but not the smallest, 235 million. And they engage in exploration and development in the United Kingdom, Australia, and Austria. Australia is such a great place for finding out and finding minerals and stuff like that. And these companies, typically with 3 employees, they're all about contracts, discovery, funding, and what they can hit. So that's added onto the watch list. I'm keen to monitor that. And then as well, CF Holdings. Last week, we had a lovely comment from Josh talking about fertilizers and possibly keep an eye on those. Here is CF Holdings. I believe they're one of the biggest fertilizer stock sort of thing within the American stock market. They manufacture and sell hydrogen, nitrogen products for energy, fertilizer, emissions abatement, and other industrial activities. Of course, over the last 3 years, it's done quite well since COVID. And then over the last year or 2 years, it's really been up, down, up, down, up, down. But this is quite interesting. They pay a dividend of 2%. And as a dividend, if you hold it every year, you're going to get 2% of the stock price as a dividend, or 2% of your holdings. In theory, that's the yield as a percent. 2% of what you hold as a payout. So that means if I had £100 in there, I get £2.11 dividend. P ratio, the lower the better. It is very low in this case. Seems pretty good. 15 billion market cap. They are huge. And when it comes to fertilizer, it's probably one of the few industries that is not affected by the likes of AI. So I do quite like the looks of this stock. I mean, I haven't done too much research into it, but taking a look at this, a lot of the research notes are all about holding. You've got a few targets to 97, so a few targets being up to 100, up to 97, 95. So quite positive momentum for them at the moment, but they are sitting at the upper end of that target band. Even Wells Fargo adjusting it to 113. I think one key factor here could be how much of that money, which is typically in tech stocks or services, how much of that money goes into the likes of what is safer stocks in terms of safer from AI than if it's safe in general. And so I'm going to put this in my new watch list called non-AI basket. And this is something that I would love to continue to build out. It's not core metals. I think it deserves its own separate basket. I'm going to keep an eye on this. I do like it. But let's take a look at this one. Another big acquisition in the works is Warner Bros. Discovery, possibly with Paramount, possibly with Netflix, and hence why in recent times, since the sort of merger talk, the share price has gone up quite a lot, and it's still relatively volatile based on what the bids are, what people think is going to happen, and all of this sort of stuff. There's hostile bids, there's deal sweeteners. Netflix, if they don't get a deal, will get 2.8 billion paid to them for nothing. It's all going pretty crazy with the merger and acquisition world. What actually happens, I don't know, but just take a look at that streaming line there. It's pretty interesting to see how it's gone. But the reason why I want to take a look at sort of streaming and news is New York Times. I believe in recent weeks, one of the only positions that has been taken up by Berkshire Hathaway, who have notoriously been holding and stockpiling cash, has been the New York Times. Targets are going up to $75. They're being hit. They're being smashed. Very interesting to see that this company which traditionally newspapers were dead, 12 billion market cap. Very interesting to see that they have had such a big resurgence and such big backing at the top by Warren Buffett. And I think he's a man that's proven himself massively over the years. So I'm going to add that to my watch list, actually. Let's get New York Times onto my watch list. I'm not quite sure if this is going to be a product that I invest in, just due to my personal nature of not really consuming it. So if I don't consume it myself in terms of digital news or newspapers or online outlets, I'm not quite sure if I want to buy it. But I'm going to add it to the non-AI basket and just see what happens there. Although they kind of pivot into AI theory, but news will always be, I don't know. It's not tech, is what I'm saying here. Anyway, I might sort out a different basket for that later on. So there are a few adjustments we made to the portfolio, a few that we're looking into. I wanted to take a look at some bigger names in tech. Right, where is this now? So the uranium and nuclear portfolio, is basically at its peak. Again, Amazon doing quite well, Satl doing well. There's a lot going on, basically, over recent times. Planet Labs flying back up there, Rocket Labs getting back up there. So when it comes to what do I want to invest in next, I think Nvidia has had an absolute stonker an absolute great play over the last few weeks. It's gone up pretty much from 174.5 points to 200. So you're even making gains on that. IonQ's up massively today. Some of the big companies over recent months have traded down though due to the fear of AI taking over, like IBM. I wonder if this could be a very interesting opportunity for an investment going forward, the next acquisition to my portfolio. Why? Well, London Stock Exchange Group, typically the markets are rising with more people investing. There's a lot of push on the stock markets as a way to grow wealth going forward from the government, from politics. The London Stock Exchange, the ETFs are the highest they've been overall for the FTSE 100, yet the Stock Exchange Group, which isn't directly connected but analyzes all the data and helps with that market analysis as such, has actually struggled in recent times. Now, 1.74% dividend yield, quite a high price to earnings ratio, which you'd always look for lower, and a market cap of 39 billion with a medium volatility. It's still pretty high. Now, over recent weeks, over the recent year, it has gone down a fair bit, once again on fears due to the likes of AI taking over and actually being a lot bad for its business because the AI can do it. However, there's been quite a few research notes that have come out giving this quite a high target from certain brokers. People saying that yes, while AI is going to ultimately be involved a lot more in the business of the London Stock Exchange Group, they actually have all the data and analytics that AI companies will want to build the models. And so together, they're quite a valuable pairing. And I thought that's quite an interesting premise. This group of people have a lot of data. The beta is medium volatility. It's had a rough few weeks and months and years, but over the last month itself has rebounded 10%. So balanced short-term momentum and a lot of chatter around buybacks and everything like that. So I think I'm going to open up a new position in this. You can explore the financials and trade 2 and 2 as well, which is great. So gross profit, 7.69 billion, 8 billion of revenue, and the cost of that revenue is 1 billion. So their margins, 86% is pretty good. But obviously lots of operating expense as well. And income before tax, 1.2 billion. Then you've got lots of tax. And then net income, 685 million. So 7% profit margin, that's not bad. £1.29 earning per share. I think the main thing there that your price to earnings ratio is suffering a little bit. That's probably why it doesn't look the most appetizing. But I still think that this could be a value play if data's the future. How much data and important data they have in an industry which is growing. In my non-financial advice opinion, and please don't copy anything I do, I'm not a financial advisor, I'm not qualified at all opinion based on educational content, I am going to actually buy this, but all of my money is first in American dollars. So I need to convert from USD. I'm going to convert 5,000 and I have to pay £5.54, the foreign exchange fee, as always is the case. I'm going to get, how many can I get? 40 shares tomorrow, and the market, I don't know when it's going to open, but I'm going to set the price of 78,000 or 7,800 pennies as my limit, and I'm going to select buy. So that order is now going to be settled hopefully in the morning, assuming price doesn't open above that. They also report earnings very soon, so I'll look to see how that earnings release goes, and subsequently after that earnings release, I'll look to see if there is a feasible way to either get my average down if it goes down, or get some more skin in the game if I like it. But overall, thank you very much for checking in with me on a brand new episode of the Stocks and Shares series. It's been a wild week. Lots has been happening, but make sure you leave a comment below, like, subscribe, join the channel if you want even up closer and personal access. I appreciate everything. But yeah, thank you very much. And if you are here till the very end, true trooper, please do let me know in the comments.
This content is for educational and informative purposes only and represents my personal opinions. It is not financial advice, investment advice, or a recommendation to buy or sell securities. I'm not authorized or regulated by a financial conduct authority. Investing involves risks, including potential loss of capital. Always do your own research and consider seeking advice from a qualified FCA regulated professional, which is definitely not me.